Hi everyone. So I'm gonna go ahead and share my screen. So this is the CLO4 presentation that I'm gonna talk about. So there's two bonds. So A and B have the same credit, bonds A and bond B have the same credit rating and the same par value and the same coupon rate. So bond A has 30 years to maturity and bond B has 5 years to maturity. So I'm gonna give a brief overview of the topics that cover in the assignment. So bond valuation, time value of money, and also the relationship between bond prices and interest rate. Um, so next coming up, I'm gonna talk about the specific focus of the presentation, which is analyzing the valuation and the pricing dynamics of two bonds at different maturities. So description of bond A and bond B. So both bonds have the same credit rating per value and then also the coupon rates. So bond A has 30 years to maturity and bond B, while it only has 5 years to maturity. So the maturity of the bond refers to the length of the time until the bond reaches its expiration date and maturity date, at which point the issue repays the bond principal amount to the bondholder. So maturity plays a very significant role in bond pricing and influence investor preferences for several reasons. Um, and then there's also interest rate risk. So bonds with longer maturity are more sensitive to changes in interest rate because then those in shorter maturities. The reason why is that the maturity of bond refers to the length of time until the bond reaches its expiration date, or the maturity date, and which point the issuers repays the bond principal amount to the bondholder. So maturity plays a very significant role in bond pricing and influence investor preference for several reasons. And two main reason that I could think of, it's interest rate risk. So bonds of long maturity are more sensitive to change in interest rate than those with shorter maturities. This is because the longer the term bonds exposes investors to a longer period of potential interest rate fluctuation. So as a result, investors typically demand higher yields or interest rate for longer term bonds to compensate for the increased risk of fluctuation in market interest rates. And another one would be reinvestment risk. So longer term bonds also carry reinvestment risk, which refers to the risk that future cash flow, so coupon payments, etc., may need to be reinvested at a lower interest rate than the bond original yield. So I'm going to tell explanation why bond A will have trading at a higher price. So bond A, because it has a longer maturity date, and bond A provides investors with longer term cash flow, leading to a higher present value. And also, investors generally demand higher price for longer term securities, like we talked about in the last slide, to compensate for the increased risk and uncertainty. So the concept of time value of money, its relevance to the bond valuation as well. So to discuss how change in interest rate affect bond prices. So bond prices and interest rate have an inverse relationship, very different than the picture that we're showing. That's just a picture we found online. So an inverse relationship according to the bond pricing. So the relationship is driven by the fact that the existing bond with fixed coupon rates become less attractive when the market interest rate rises. So market prices change it in response to interest rate increase. So I'm going to explain what happens to the market price of each bond if interest rate go up. So bond A with the longer maturity experiences a larger decrease in price compared to bond B. And shorter term bond B is less affected by interest rate change due to its shorter duration. And I'm going to mention about the concept of reinvestment risk and also impact on the longer term bond as well. So bond A will have a higher percentage price change due to its longer duration and higher sensitive to interest rate movement. And we're going to conduct more calculations of the percentage price change for both bonds in response to a hypothetical interest rate increase. So I'm going to provide a numerical examples here. So for bond A, so let's say if the coupon payment per period is $50, the per value of this bond is 1,000. So a maturity is in 30 years. So using this bond pricing formula, the current interest is at 5%, and the interest rate increased by 1%. For bond B, the payment period is also at 50. Per value, it's also 1,000, but the maturity it's at 5 years. So the current interest rate at 5% is showing here, and the interest rate increased by 1%, it's here. So we can calculate these using a financial calculator or Excel's. And once we have the price for each scenario, we can compare the impact of the interest rate changes on the price of both bonds. Recommendation for bond investor expecting a slowdown in the economy. So considering shifting towards shorter term bonds or bond funds to minimize the interest rate risk, we can also diversify across different types of bonds and to spread risk and also capture different potential opportunities in various market conditions. So in conclusion, the importance of understanding bond valuation principle and also the complexity, the duration, and also their implication and for investment decision are very important. And significance of considering maturity and interest rate sensitivity when evaluating the bond investments will also help to determine whether you're making a good investment strategy. So that's it for my presentation, and thank you so much.